In December, Sydney and Melbourne quietly did something they haven't done in almost a year. Prices fell, just 0.1%, barely noticeable. But in property cycles, this is the moment everything changes. Because when Sydney and Melbourne slow first, the rest of the country always follows. And this time, the warning signs are already flashing in cities most buyers still think are safe. By the end of this video, I'll show you exactly which Australian cities are next, ranked by risk, and the 3 signals that tell you the slowdown has already started where you live. Let me show you how property slowdowns spread across Australia. According to decades of property cycle data, slowdowns don't hit all cities simultaneously. They follow a predictable pattern. Phase 1. The largest cities peak first. Sydney and Melbourne, with the highest prices and worst affordability, always slow first. December 2025 marked Sydney's growth at just 0.5% monthly, Melbourne at 0.3% before both turn negative. Phase 2. The boom cities follow 6 to 12 months later. Cities experiencing rapid recent growth: Perth up 13.1% annually, Brisbane up 12.8%, Adelaide up 9%, eventually hit their own affordability ceilings. The slowdown spreads. Phase 3. Regional markets. Lag behind regional areas, which have outperformed capitals recently, are the last to slow. But when they do, the correction can be severe because they lack the economic diversity and employment depth of capital cities. We're currently entering Phase 2. Sydney and Melbourne have slowed. Now the question is, which boom cities are next? And one of them is already showing the same warning signs Sydney did right before prices rolled over. But almost nobody's talking about it yet. According to AMP's Dr. Shane Oliver, after 8.5% growth this year, we anticipate some slowing in national average home price growth to around 5 to 7% next year. With FOMO running hot in the boom time cities of Brisbane, Perth and Adelaide, they are likely to remain the strongest over the next 6 months. 6 months. That's the window before the slowdown reaches them. Let me show you which cities are most vulnerable, ranked from least to most at risk. These cities will slow down last, but they're not immune. Darwin, strong but vulnerable. 2025 performance, 18% growth, the highest nationally according to Propertyology. 2026 forecast, 12 to 16% growth according to SQM research. Major gas projects driving demand, rental yields strong. But here's the warning. Darwin's mortgage arrears rate sits at 1.75%, the highest in Australia. The economy lacks diversity. When gas projects complete, demand evaporates. Darwin is strong now, but vulnerable later. Regional Western Australia and Queensland 2025 performance. Regional WA up 16.1%. Regional Queensland up 12.6%. Propertyology forecasts more than 66 regional townships will produce at least 6% growth in 2026. Towns like Albany WA, Port Augusta SA, Townsville QLD, Geraldton WA, and Mackay QLD recorded approximately 20% growth in 2025. But this can't continue indefinitely. When capital city growth slows, investor interest in regional areas collapses. According to property data, regional markets are not completely immune to slowdown. The monthly pace of regional growth already slowed from 1.2% in November to 1.0% in December, but these low-risk cities are the exception. Most Australian markets face serious slowdown risk. These cities are already showing early warning signs. Adelaide, the affordability wall, 2025 performance, 9% growth, overtook Melbourne's median price for first time. 2026 forecast, 10 to 14% growth according to SQM, but with critical constraints. Vacancy rates around 1%, demand at 5,500 dwellings versus supply of 4,800. But here's the problem. Adelaide mortgage repayments now absorb 51.5% of household income, up from 27% in 2019. That's the most dramatic affordability shift of any Australian state. According to Domain's Dr. Nicola Powell, the extreme rate of price growth in entry prices over the past 5 years has been led by Adelaide, Brisbane, and Perth. Adelaide's median house price hit $814,430, overtaking Melbourne. When repayments absorb over half your income, you've hit the affordability ceiling. Adelaide's growth will slow in 2026. It's mathematically inevitable. Sunshine Coast and Gold Coast lifestyle premium tested 2025 performance. Strong growth driven by lifestyle migration. 2026 forecast, Sunshine Coast 10 to 15%, Gold Coast 7 to 11% according to SQM. Both regions continue benefiting from lifestyle-driven demand and constrained supply, but they're increasingly expensive, testing the limits of what buyers can afford for lifestyle premium. According to property analysts, both regions continue to benefit from lifestyle-driven demand and constrained housing supply. But as national affordability worsens, discretionary lifestyle purchases become harder to justify. These medium-risk cities will slow in the second half of 2026, but two cities face imminent deceleration, and one of them isn't slowing because demand is weak, it's slowing because demand got too strong, too fast. These two cities are next in line for major slowdown. Brisbane, the FOMO peak, 2025 performance, 12.8% growth, record high prices. Monthly growth, 1.9% in November, third highest nationally. 2026 forecast, various predictions from 5% slower to 16%, continued boom. Here's why Brisbane is at high risk. Entry-level house repayments absorb 46.4% of income. Entry-level unit repayments exceed 30% threshold at 34.4%. Brisbane prices have risen from $390,000 in 2019 to $617,500 today, a 58% increase. According to AMP's Dr. Shane Oliver, Brisbane is one of three boom time cities where FOMO is running hot, but that FOMO is exactly what signals a peak. Units in Brisbane are now outpacing houses. 2.2% growth versus 1.8% growth. That's a classic late cycle signal where buyers trade down to more affordable options because they're priced out of houses. Brisbane's Olympics-driven narrative supports prices through 2026 to 2027. But here's the reality. Major infrastructure projects peak 2 to 3 years before the event. The Gold Coast Commonwealth Games in 2018 saw property prices fall in the years following. Suburbs with high apartment supply like Chermside and Fortitude Valley already show oversupply warning signs. When the broader market slows, these areas will get crushed. Perth, relative affordability, disappearing 2025 performance, 13.1% growth, second highest nationally. Monthly growth, 2.4% in November, highest in Australia. 2026 forecast, 5.3% construction cost increases, continued strong demand but slowing pace. Perth was Australia's darling in 2024 to 2025. Investors piled in seeking affordable property, but here's what's changed. Perth's median house price hit $740,000 after surging 24% in 2024. Perth's price-to-income ratio is now well above Melbourne. According to Dr. Shane Oliver, entry-level house repayments absorb 37.3% of income. Dr. Shane Oliver's warning is explicit. As Perth's relative affordability continues to deteriorate with home price-to-income ratios now well above Melbourne, some sort of rotation back to the laggards is likely. Translation: Perth's advantage is gone. Investors who bought expecting continued double-digit growth are about to face reality, affordability constraints, slowing demand, and potential reversal of recent gains. CoreLogic data shows Perth had all 302 suburbs record price increases in 2024, 0 declines. That's not sustainable. When markets show 100% uniform growth, a correction is imminent, but there are 3 specific warning signs that signal when your city is about to slow. Every property downturn looks obvious in hindsight, but painful if you ignored these signals while they were happening. Here's how to predict if your city is next. Warning sign. Number 1, days on market increasing. When properties take longer to sell, that's the first signal demand is weakening. Sydney and Melbourne auction clearance rates now hold below decade-long averages after surging to 2-year highs in September. According to property analysis, momentum in Sydney and Melbourne is being weighed down by softer auction market results. When clearance rates fall below historical averages, prices follow within 3 to 6 months. Check your city's days on market data. If properties are taking 10 to 20% longer to sell than 6 months ago, the slowdown is starting. Warning sign. Number 2, monthly growth rate declining. National growth already slowed from 1.1% in October to 1.0% in November to 0.7% in December. That's the trend. Sydney slowed from 0.5% to negative 0.1%. Melbourne from 0.3% to negative 0.1%. Brisbane's 1.9% monthly growth is unsustainable. It will moderate to 1.0%, then 0.5%, then potentially negative. When your city's monthly growth rate halves within 2 to 3 months, that's a clear deceleration signal. Warning sign number 3, price-to-income ratios. Above 8 times Australia's national median hit 8.0, meaning houses cost 8 times annual household income. That's near record territory. Adelaide's ratio exploded from affordable to over 8 times within 5 years. Perth's ratio is now well above Melbourne. Brisbane's ratio continues rising. When price to income exceeds 8 to 9 times, affordability becomes mathematically impossible for median earners. Growth must slow. So what happens when these cities slow? And what should property owners do? Here's what happens when boom cities hit the wall. According to property forecasters, 2026 growth will moderate to 4 to 14% nationally depending on economic conditions. But that national average masks huge variations. Likely outcomes for high-risk cities. Brisbane, growth slows from 12.8% to 5 to 8% as affordability constraints bite. Perth, growth slows from 13.1% to 5 to 7% as relative affordability advantage disappears. Adelaide, growth slows from 9% to 4 to 6% as 51.5% income to repayment ratio becomes unsustainable. For property owners, this means capital gains evaporate. Your expected $100,000 gain becomes $30,000. Holding costs increase. Interest rates, insurance keep rising. Negative cash flow worsens. Rental yields fail to cover costs. Exit becomes harder. Fewer buyers compete for your property. According to CoreLogic's Tim Lawless, uncertainty around inflation and interest rate settings is likely to weigh on housing confidence, along with ongoing affordability challenges and renewed focus on household debt and credit policy. Translation: 2026 is a fragile market. One rate hike, one unemployment spike, one policy change, and growth turns to decline. If you're in a high-risk city, here's what you must do. Strategy number 1, lock in gains now if you're selling. If you bought in Perth, Brisbane, or Adelaide 2 to 3 years ago and have significant equity, consider selling in Q1 2026 before the slowdown accelerates. List before Easter when seasonal demand peaks. According to property analysts, high growth levels in cities like Perth, Adelaide, and Brisbane may be difficult to sustain as affordability becomes more stretched. Don't wait for the slowdown to accelerate. Sell while buyer confidence remains. Strategy number 2, focus on affordable segments. According to market data, demand is increasingly focused on more affordable market segments, with significant growth in the lower quartile of the market. If you're buying in a high-risk city, target entry-level properties where government schemes and first home buyer demand remain strong. Avoid premium properties where discretionary buyers are first to exit. Strategy number 3, avoid oversupplied precincts. Entirely, Brisbane's Chermside, Fortitude Valley, and other high-density apartment areas face oversupply. Perth's outer fringe suburbs with limited amenities underperform even in boom markets. Adelaide's rapid development zones may have been overbuilt. Research new apartment approvals in your target area. If there are 1,000 plus apartments under construction, that's oversupply waiting to hit. According to property forecasts, suburbs with a high supply of new apartments may see price declines due to oversupply of units. December 2025 marked the turning point. Sydney and Melbourne fell 0.1%, the first month-on-month decline in nearly a year. National growth slowed from 1.1% to 0.7% in 2 months. Tim Lawless explicitly stated the slowdown hints at a weaker start to housing trends in 2026. The cities next in line: Brisbane, 46.4% of income on house repayments, units above 30% threshold, 58% price growth since 2019. Perth, relative affordability, well above Melbourne, 13.1% annual growth unsustainable. All 302 suburbs rose, correction imminent. Adelaide, 51.5% of income on repayments, fastest affordability deterioration nationally, overtook Melbourne's median price. The 3 warning signs are spreading. Days on market increasing across Sydney, Melbourne, and starting in other capitals. Monthly growth rates declining from 1.1% to 0.7% nationally in 2 months. Price to income ratios hitting 8 times plus nationally, making further growth mathematically impossible. Dr. Shane Oliver's forecast is clear. Growth slows to 5 to 7% nationally in 2026. AMP expects rate hikes, not cuts. APRA's DTI cap activates February 1st. Brisbane, Perth, Adelaide have 6 months before slowdown reaches them. Property slowdowns spread predictably. Sydney and Melbourne peaked. Brisbane, Perth, Adelaide are next. The only question is whether you'll act before the slowdown reaches your city. I'll be tracking Australia's spreading slowdown every week. City-by-city growth data, days on market, clearance rates, and which markets show early deceleration signals. Subscribe so you don't miss the next video, where I'll reveal the exact suburbs within high-risk cities that will outperform, and how to position your portfolio before the slowdown reaches your market. Sydney and Melbourne fell 0.1% in December. National growth slowed to 0.7%. Brisbane, Perth, Adelaide have 6 months, and the pattern always plays out the same. The question isn't whether the slowdown will spread. The question is, will you act before it reaches your city? Thanks for watching.